Volatility and risk are used interchangeably in almost every financial conversation. Market volatility is risky. High volatility assets are higher risk. Reducing volatility means reducing risk. These statements feel true. They're repeated constantly. They shape how most investors think about portfolio construction, asset allocation, and the decisions they make during periods of market turbulence. And they're imprecise in a way that costs investors money. Because volatility and risk are not the same thing. They're related, but they're different. And the difference between them is where most of the expensive behavioral errors in investing originate. Volatistical property. It measures the magnitude of price movement, how much an asset's price fluctuates around its average or trend. A highly volatile asset moves up and down dramatically. Its price in any given week or month can be very different from its price the week or month before. A low volatility asset moves more smoothly. Its price changes are smaller and more predictable in the short term. Volatility is a description of price behavior. It's a property of how an asset moves, not a statement about where it ends up. A highly volatile asset can end up significantly higher than it was before the volatility. A low volatility asset can end up significantly lower. The volatility doesn't determine the destination, it describes the journey. Risk, in the sense that matters for investors, is something different. Risk is the probability of a permanent loss of capital, not a temporary decline in price, not a period of negative returns, not a drawdown that gets recovered. A permanent loss, capital that doesn't come back, a position that ends materially below where it started with no recovery. That's the risk that actually matters for someone with a long time horizon, not how much the price fluctuates on the way to the destination, whether the capital actually arrives. The confusion between these two definitions has a specific behavioral consequence. When investors treat volatility as risk, when they interpret price fluctuations as signals of potential permanent loss, they make decisions calibrated to the wrong thing. They sell when prices fall, because falling prices feel like increasing risk, when in most cases they represent increasing volatility in a position that will ultimately recover. They hold cash or low volatility assets because they feel safer, when in reality they're accepting a different and often larger risk, the certainty of earning below inflation returns while avoiding the discomfort of price fluctuation. They time the market, trying to avoid volatile periods, when the evidence consistently shows that timing attempts reduce long-term returns by removing investors from the market during recoveries that follow sell-offs. The definitional problem isn't semantic. It's behavioral. How risk is defined determines what decisions feel rational. If volatility is risk, selling during a sell-off is rational. Moving to safety during turbulence is rational. Avoiding high volatility assets is rational. If risk is permanent loss of capital, none of those decisions are obviously rational. Some of them are demonstrably harmful to long-term outcomes. The definition you hold shapes every decision you make during the periods when markets are most turbulent. And most investors are holding the wrong definition because it's the one they were handed by a financial industry that profits from the behavioral patterns that definition produces. Volatility is price movement, up and down, around a long-term trend, sometimes dramatically, sometimes in ways that feel alarming when experienced in real time. But price movement is not the same as loss. And understanding what volatility actually is, mechanically, structurally, changes how it gets experienced and how it gets responded to. Markets move around a long-term trend. Over long periods, decades, broad market indexes have historically moved upward. Not smoothly, not in a straight line, with significant interruptions. Recessions, bear markets, crashes, periods where prices fall 30, 40, 50% and feel, in the moment, like they might not recover. But the trend has been upward, and the periods of significant decline have been temporary relative to the holding period of a long-term investor. Volatility is the mechanism through which the market moves around that trend. It's the noise surrounding the signal. For the long-term investor, the investor who doesn't need to sell, volatility is a property of the journey, not a threat to the destination. A 30% decline in price is alarming to an investor who needs to sell in the next year. It's less alarming and much more manageable for an investor whose holding period is 20 years, because a 30% decline in a position held for 20 years is a temporary disruption to a long, compounding trajectory, not a permanent loss unless the investor converts it into one by selling. The holding period determines how volatility should be experienced, and most investors have holding periods longer than they behave as if they do. Volatility also has a second property that most investors ignore. It creates opportunity. A price that has declined significantly represents an asset available at a lower cost, more ownership for the same capital, higher expected future return from a lower starting price. The investor who continues contributing during a period of market decline, who buys more units at lower prices, is positioned differently at recovery than the investor who stopped contributing or sold. They own more of the asset at a lower average cost. The recovery lifts a larger position. The compounding starts from a better base. This is the mechanism behind dollar-cost averaging during downturns, not as a strategy, but as a structural consequence of consistent investment behavior during volatile periods. The investor who experiences volatility as threat makes decisions that eliminate this opportunity. They sell into declines, converting temporary paper losses into permanent realized losses. They stop contributing during downturns, missing the opportunity to accumulate at lower prices. They wait for the market to stabilize before re-entering, which means re-entering at higher prices after the recovery has already happened. Each of these behaviors is a rational response to volatility if volatility is the thing being avoided. Each of them is a costly behavioral error if the actual goal is long-term capital accumulation through a compounding position. Volatility isn't the problem. The response to it is, and the response is determined by how it's defined. If this made sense to you, you already understand more than most people do. This channel exists for that kind of awareness. Like the video, subscribe. Nothing here is accidental. If volatility isn't the risk, what is? For the long-term investor, the investor whose time horizon extends years or decades, the risk that actually matters is the permanent loss of capital. Not a temporary price decline, not a period of negative returns, not a drawdown that recovers, a permanent loss. Capital that ends materially below where it started, with no recovery. Understanding the actual conditions under which permanent loss occurs changes how portfolio decisions get made. Permanent loss in a broadly diversified position requires a specific set of conditions, not just a market decline that doesn't recover. For a broadly diversified position, one that owns hundreds or thousands of companies across sectors and geographies, a permanent, non-recovering decline requires something much more severe than a typical recession or bear market. It requires a structural failure of the economic system underlying the portfolio, a scenario in which the productive capacity of a diversified collection of businesses fails to recover permanently. That scenario has never occurred in developed market history over long time horizons. Not during the Great Depression, not during World War II, not during any of the significant crises that produced sharp, alarming market declines. The market recovered, not immediately, not smoothly, but it recovered. The actual risk conditions for a long-term investor are different from what volatility suggests. The primary risks are permanent loss through company-specific failure, holding a concentrated position in a company that goes bankrupt. This is why diversification matters. It eliminates the risk that any single company's failure destroys the portfolio. Permanent loss through behavioral error, selling during declines, failing to stay invested long enough for the compounding to work, making timing decisions that exit the market before recovery and re-enter after. This is the risk that most investors actually face, and it has nothing to do with the market. It's self-inflicted. Permanent loss through inflation, holding too much in low-return assets for too long, allowing purchasing power to erode while avoiding short-term volatility. This is the risk that feels safe but consistently destroys wealth over long time horizons. The behavioral error risk deserves particular attention because it's the most common and the most avoidable. An investor who holds a diversified position, who doesn't sell during declines, who stays invested through volatility, is not significantly exposed to permanent loss in a structural sense. The same investor, if they sell during the 2008 decline, if they exit in March 2009, locks in a 40% loss. If they then wait for the market to stabilize before re-entering, they miss the recovery that followed. And the gap between where they exited and where they re-entered is a permanent loss. Not because the market failed, because they converted volatility into permanent loss through a behavioral decision. The risk for most long-term investors isn't in the market. It's in how they respond to the market. And the misidentification of volatility as risk, the treatment of price movement as a signal of permanent danger, is what drives the behavioral decisions that actually create the permanent losses they were trying to avoid. The storm is real. The volatility is real. The price movements are real. But for the investor with a long enough time horizon and a diversified enough position, the volatility is not the risk. The response to it is. Understanding the distinction between volatility and risk is not enough on its own. Because understanding something intellectually and maintaining that understanding when markets are falling, when every financial media outlet is alarmed, when the portfolio is down 30%, when friends and colleagues are selling, are two different things. The behavioral framework that allows long-term investors to hold through volatility has to be built before the volatility arrives, not during it. The first element of the framework is clarity about time horizon. An investor whose holding period is 20 years should not be making decisions based on what the market does this week. That sounds obvious, but most investors don't have a clear, explicit articulation of their time horizon, one that they've committed to and that guides their behavior during turbulent periods. Without that clarity, the time horizon compresses under emotional pressure. What was a 20-year investment becomes a 10-year investment, becomes a 5-year investment, becomes a decision made based on today's price. And the long-term investor makes short-term decisions, not because their actual time horizon changed, because the clarity about it wasn't established firmly enough to hold under pressure. The second element is a written investment rationale, not a strategy document, not a financial plan. A clear articulation, in writing, of why the position is held, what the expected long-term return is, what the basis for that expectation is, what conditions would actually justify changing the position. The purpose of the written rationale is to create a reference point that exists before the volatility occurs, when thinking is clear, that can be consulted during the volatility when thinking is emotionally compromised. A decision made in the middle of a market panic is not the same quality of decision as one made in calm conditions. The written rationale is a mechanism for carrying the calm condition thinking into the panic condition moment. The third element is deliberate exposure reduction, not elimination of risk assets, not a move to cash during volatile periods. A portfolio that is sized correctly for the investor's actual risk tolerance, not their stated risk tolerance, is one they can hold through volatility without the emotional pressure to sell becoming overwhelming. An investor who is overexposed to equities, who holds more than they can emotionally sustain through a 30% decline, will sell at the worst time. Not because they're undisciplined, because the position was never calibrated to their actual behavioral capacity. The right portfolio isn't the one that produces the highest theoretical return. It's the one the investor can actually hold through the conditions that will inevitably arrive. Volatility will arrive. That's not a prediction. It's a structural property of markets. The investor who has clarity about time horizon, a written rationale for their positions, and a portfolio sized to their actual capacity experiences volatility differently than the investor who doesn't. Not because the price movements are smaller. They're the same price movements. Because the behavioral response is different. The framework holds. The position is maintained. The compounding continues. And the volatility that converted the underprepared investor's position into a permanent loss becomes, for the prepared investor, the noise that surrounded a long-term return they were positioned to receive. If this shifted something for you, subscribe. Like this if it clarified something.